My name is Lorenzo. I work at the Credit Union of Colorado as a loan officer. And today, this presentation is going to be about auto loans. So we're going to answer a few questions here, all in this section here. So, what is an auto loan? How do I get an auto loan? What to consider when purchasing? Interest rates, and then credit. So, first and foremost, what is an auto loan? Simply put, an auto loan is a loan that is used for a vehicle. Financial institutions, banks, and credit unions agree to lend you the money to purchase a vehicle, and then you agree to pay them back through monthly payments plus interest for a certain amount of months. Generally, you get to pick the day of the month that you want your payment to due. This is a benefit for auto loans because just depending on how you get paid, you can kind of structure when you want your monthly payments to be due. So if you get paid on the 1st and the 15th, it may be beneficial for you to make sure your auto loan payment is due on the 15th because you're going to get that, you're going to have money around that time. So that's why it's a benefit here. I'm going to move this over here. Auto loans are also considered closed-end loans, which means they have a specific closing date. For example, 3 years, 4 years, 5 years, etc. This is different from a credit card or any other open-end lines of credit because, like credit cards, they don't have a specific closed-end date. They're just constantly going and going. They're like a revolving type of credit, whereas auto loans, whenever you basically sign a contract, so there's going to be a specific close-in date. You're going to have 3 years to pay this one off, or 4 years, or 5 years, or whatever the case may be. So why do people need auto loans or just loans in general? So most individuals do not have enough cash or liquid assets to be able to pay in full for these big ticket items such as vehicles, houses, boats, RVs, business startups, etc. And oftentimes, borrowing the money to purchase these big ticket items is more beneficial than waiting months or even years to save up enough cash to pay for these things in full. As a result, most banks and other financial institutions will agree to loan you the money to purchase these things. However, not only will you be required to pay back the money you borrowed, but oftentimes you'll be required to pay interest, which we'll get into right now. So, move my head over here. So interest is the fee that banks and other lenders charge you for the privilege of them allowing you to borrow the money. When you make your monthly payment, it gets split up into two portions. A portion goes to your actual debt, so decreasing the amount of money you're in, and then a portion goes to the principal, or directly to the lender for the interest. So it's a good way to think about it. Interest rates typically range anywhere from 0%, which is the best, and 36%, or even higher in some cases. So why is interest so important? First and foremost, a goal to have when choosing an auto loan, or really any loan for that matter, is to pay as little interest as possible. So this way, when you make your monthly payments every month, most of the money goes down to actually decreasing the amount of debt you're in, and not to the interest. Interest is important because it can either allow you to save more and decrease the amount of debt you're in, or the complete opposite. Or it can restrict the amount of money you're able to save and prolong the amount of time you're in debt, which is what we don't want. Interest percentage rate is determined mostly by your credit score, which we'll go over here shortly. However, there are other factors such as the loan term and the age of the vehicle and some other things as well. So you're searching for your car. What are some things you should consider? Big one here. Understand your budget. This is huge. It's important to understand your budget just to know how much you're comfortable paying each month after all of your other living expenses gas, insurance, rent. You still want to be able to live comfortably without having to pay a huge amount on your auto loan, on your car payment. One thing to be aware of, though, is sometimes salesmen, just to make it more appealing and to try to make a sale, what they'll do is they'll extend the length of the loan. Instead of maybe 60 months, they'll say, you know what, we can do 84 months, which will lower your monthly payment. But, you always have to remember, the longer you're paying on a loan, the more money you're spending on interest. So that's just one thing to keep in mind, because salesmen do try to do this just to make it more appealing and to try to make a sale. But, as long as you remember that the longer you're paying on a loan, so instead of the 60 months, which is 5 years, you go for 84 months, you're going to be paying on it a lot longer. So just keep that in mind. Another thing is just consider other costs. So the sad part about buying a new car is you're not just buying the car. There are many more costs involved that you need to budget for, which I didn't realize when I purchased my first car, but it's these things in here. So we got taxes, warranties, insurance, dealer and handling fees, plates and tags, fuel cost. How economical is your car going to be? Oil changes and maintenance. And then, of course, we have repairs. So if anything goes wrong with the vehicle, it's going to be up to you to get it fixed. Next is understanding your financing options. So put this down here. There we go. So generally speaking, younger individuals ages 18 to 21 do not have not built up enough credit to convince lenders that they are trustworthy enough. This is a big word when it comes to lending and borrowing and credit and stuff like that. You want to present yourself as trustworthy as possible. And the best way to do that is just to build up your credit score and have good history on there. But if you're like most younger people, we're in this section here. So if you're like most younger individuals, and you fall within that same boat, and you don't have much credit or you don't have any credit at all, there are still some options out there for you. So biggest tip here is just get credit started. That's really the biggest tip we can give you. And especially if you're not in a huge hurry to get a vehicle. I know some people are in a huge hurry to get a vehicle. They want to ditch the skateboard. They want to ditch the vehicle that their parents let them have or whatever. But like I said, if you're not in a huge hurry to get a vehicle, getting credit started with a small credit card or a secured credit card is a great first step. You can begin to establish credit for 6 months or a year, and then you can really develop a good credit score within that 6 months to a year if you make all your payments on time and do everything you're supposed to. Now, if you're under 18, establishing your credit is a little bit more difficult just because there's not a lot of options out there for you. However, this can still be done by getting added as an authorized user on either your parents' credit card or another adult. This means being an authorized user basically means that you have access to the card, but you're not liable for paying it back. That's what that means. So, having a cosigner or a co-borrower. So a cosigner or a co-borrower is basically someone who backs the loan, basically someone who assumes responsibility for the loan. Although, a cosigner and a co-borrower, there are some slight differences. Really, the thing that they do is they can both provide support and strengthen your chances of getting approved from a lender. Ultimately, both cosigners and co-borrowers assume responsibility for the loan, as I mentioned earlier. But one thing is very important. It's important that you understand that if you do default on the loan, aka you make late payments, it will negatively impact you as well as the individual that is signed for you. So that's really important to understand. If you do have a co-signer or a co-borrower, and you make a late payment, it's going to affect them as well. So just just make sure you understand the responsibility. Another thing that can help you is a bigger down payment, or just a down payment at all. Here. As we mentioned earlier, most people don't get loans because they don't have enough cash to buy in full. However, having a down payment can help in many ways. First and foremost, a down payment will decrease the amount of money that you have to ask to borrow from the bank. And from a bank's perspective, it's assuming less risk since you're asking for a lower amount. Consider this hypothetical situation here really quickly. So, two 18-year-olds are both applying for a $10,000 loan. One has a down payment of $2,000 and the other has no down payment. In your opinion, which one is less risky? The 18-year-old asking for $10,000 or the 18-year-old asking for $8,000 because he has $2,000 of his own to put down? Now, the answer is pretty obvious here in this situation. Obviously, the individual asking for the $8,000 because he's invested $2,000 of his own to put down. Some more benefits of a down payment is your monthly payment will be lower since you are basically financing less. So instead of asking for the $10,000, you're asking for $8,000, which means your monthly payments are going to be lower. You're also going to pay less interest because the length of the loan is going to be shorter since it's a smaller amount. Another big one here that some people don't realize also is it helps you offset depreciation. Here, you can't really see that. So we all know that cars, they lose value, especially new vehicles. As soon as you drive them off the lot, they decrease in value. It's not like a home or any other appreciating assets where they gain value with time. Vehicles are different where, the more miles you put on them, if you get in an accident or any other things happen to the vehicle, they lose value. So if you put a bigger down payment, it kind of offsets the depreciation. And I know I really didn't understand depreciation when I was in high school also. But basically, I'm sure most of you have heard the phrase, "I'm upside down in my vehicle." And what that means is basically that you owe the bank, let's use that same situation. You owe the bank $10,000, but the vehicle is only worth $5,000. That means that you're upside down, And if you were to sell the vehicle, even like a private party purchase, you were to sell it, no one's going to give you $10,000 because the vehicle is not worth $10,000. It's only worth $5,000. So even if they give you the $5,000, you're still left paying another $5,000 to the bank to release the loan and get the title and stuff. So just something to keep in mind. It does help offset the depreciation. So moving forward, what should we do before even applying for a loan? So you need to have a good idea of two things: your credit score and your income, because these are going to be the two things that we as lenders are going to look to determine if you qualify to borrow. And also, if you are planning on using a cosigner or a co-borrower, you need to know who that is, and it's also a good idea to know their income as well as their credit score, because you want to present yourself as best as possible whenever you're applying for a loan, and you kind of want to you want to give yourself the best chances. So you want to, if you have two co-borrowers or co-signers in mind that are both willing to help you, it's a good idea to know which person is gonna strengthen the loan and help you get the loan the best. So applying for loans. First things first, in this bullet point here, begin to compare quotes. So now it's easier than ever to hop online and search for different dealerships and different credit unions and banks and find out, who has the best interest rate, and kind of the minimum credit score qualifications, because most lenders, as it states here, most lenders will list their best interest rates as well as the minimum credit score qualifications. Another important tip is it's important to compare, because your local bank or credit union that you have an account at may give you a better interest rate than the dealership just for being a member with that bank. And like we said, interest is very important. Third bullet point here, once you've narrowed down your search, you can begin to apply and get pre-approved for an auto loan. Now, assuming everything went well, you went through that whole journey, now, hopefully you're approved, everything went well. After you've been approved, you can search for the vehicle that you want, that's within your budget, of course, and you may have already found the vehicle that you want. Then it's even easier from there. You just start signing and making sure that all the terms are as agreed, and we'll go over in the next slide of all of the key terms that you need to remember before you even start signing contracts and security agreements and stuff like that. But yeah, once you find the right vehicle, you're ready to close on the loan and drive off. So these are the loan terms that I was talking about. Good idea to remember all of these here. These are all super important, and they will all be in the closing documents that you sign. So number one is the principal. This is the amount of the loan that you are financing. The loan term, this is the length of the loan. So this is if you're going to be paying for 48 months, 60 months, 84 months, etc. Interest rate, this one is very important. This is the percentage that the lender is charging you for borrowing funds. Remember, they can be anywhere from 0% all the way to 36% or even higher in some cases. One thing I didn't mention too, as considering you're most likely buying your first vehicle or getting financing for your first vehicle, you don't always have to get the best interest rate, especially considering your credit's new, so you're most likely not going to get the best interest rate regardless. But just something to keep in mind. There's also something wasn't really discussed in this, but it's called a refinance. So let's say you have a credit score of, we'll just say 600, and they give you a 15% on your interest. If you decide to do that and you move forward with that, close on the loan, you can pay on that loan for 6 months or 12 months, and then you can do what's called a refinance. And basically, a refinance is you re-sign documents and you refinance the loan, and typically it's for a better interest rate. So let's say you've paid on the loan for 6 months or 12 months or whatever the case may be. Your credit score is going to go up. Since you've been paying, you have good history, it's going to go up. So say you were at a 600, just hypothetically speaking, now you're at a 700. So now you're in a different bracket. So you're gonna qualify for better interest rate. So now you have the option to get a better interest rate, and that's basically what a refinance is people do it for better interest rates or to cut down their loan term and for various other things. But those are kind of the two biggest reasons people do the refinances. Let's see what happened there. There it is. Prepayment penalties. This one is important as well. So you want to make sure that there is no prepayment penalties. Prepayment penalties basically means that the lenders could penalize you for paying early on your loan, which is crazy, and you just want to stay away from lenders who penalize you for paying early. So just make sure there's no prepayment penalties. And then collateral. So since we're talking about auto loans, collateral in this case would be the vehicle. Lenders are basically using the vehicle as collateral for in the event that you default on the loan, which means you don't pay on the loan, they have the authorization to basically repossess the vehicle and take ownership of the vehicle, because they are putting that up as collateral. But yeah, we're at the end of the PowerPoint presentation. So if you guys have any other questions or any other financial topics that you would like us to discuss, we'd love to help you.